Thank you, Mr. Vijay, for being with us today. It's a pleasure having you. And let's start from the decision of yesterday, the Saudi Arabia and Russia. Do you think it will guarantee that oil prices will be over $90 until the end of the year?
Well, the oil output cut by Saudi Arabia was definitely a surprise. But as such, it was just a surprise because it was an extension till December. We do expect that more such oil cuts will definitely be coming in, not just from Saudi Arabia and Russia, but actually all the OPEC plus countries if we see a slowdown in the economy. So Saudi Arabia did the cuts, Russia did the cuts, expecting a slowdown in the economy, which is definitely looking like a possibility. At the same time, we did see that Fed might even increase interest rates even further than what we already have seen this year. So, given the situation, it does look possible that there could be even further oil output cuts if we see the economy actually do falling.
But today, more decreases within higher prices and a weaker economy, and this is according to the numbers from Europe, Asia, and China. But it's surprising that the demand was strong in China, especially for traveling. Don't you think that higher oil prices will impact negatively on economy?
Absolutely, what we possibly can see could be a completely negative spiral on it. The oil production is being cut because of an expected weaker economy, but the decrease in oil output will actually lead to higher inflation, which will again lead to a much more weaker economy. It is definitely a negative spiral, and we have the CPI numbers coming in next week. We have seen oil above 80 for the entire month last month, and we might see it above 90 for the rest of the year. That will definitely impact the CPI numbers, and if it does, then we will see even further more rate hikes, which could lead probably to not the soft landing that we actually had pretty much banked on, that the Fed was saying that there will be a soft landing on the economy. It could be changed right now. The situation is very, very difficult.
Even it's striking that prices today are close to what they were in a year. So if we have the base effect, we could see higher inflation numbers, how it will impact the expectations of interest rates. The ISM for the service sector in the US, we had strong numbers. How do you expect to impact not on the Fed, but even on other central banks like the ECB and the Bank of England?
So that is definitely a major issue that all central banks around the world will see. If they do see higher inflation numbers, US Fed is very open about a 50 basis points rise for the rest of the year as well. But ECB and the Bank of England are not very certain if they can afford further rate hikes. But if the inflation numbers do come out even stronger, then they'll have no other option. The only problem with that is it actually leads to a much weaker economy, and not just that, a much weaker market. We have seen a very, very stable market so far in the year, but historically we have seen seasonality wise, it is September and October which has been so far disastrous for the markets. Let's hope that's not the case this time around. But a situation is being created that such a situation can come in.
Thank you very much, Mr. Vijay Valesha, for being with us today.
Thank you so much.